daily yield curves and rates. So let's see if this one will give it to us. No, that doesn't give us a yield curve. What I'm looking for is actually a yield curve, so you guys can understand how the front end of the interest rates are really tied by the Federal Reserve. I can't find it right this second, but I will find it and I will post it later today on our closing bell video, but it should be here in a second. Hold on one second, folks. I don't mean to be wasting your time. U.S. Treasury yield curves. If this isn't it, I give up. Okay, so we found it. Okay, so here's what's happening. The Federal Reserve, if you look at the short end of the yield stick, so here is a Treasury yield curve. Okay, so let me get my head out of the way so you can understand this whole market. Okay, so over through here, this is long term. So if you go down through here, this is 30-year rates. Okay, and these are Treasury bonds. Okay, up through here, this is 1 month, basically 0, 1 month, 2 month, and it works also all the way out to 30 years. Okay, so what happens is usually the short end of the stick, right through here, this is usually way down here. Well, why isn't it moving? Well, it's because of the Federal Reserve. Okay, so if you want to see basically a normal yield curve, let's go back to maybe 2020. Let's see what this is a normal yield curve, folks. So you see short end rates are basically virtually almost nothing, because if you want to invest for 1 month, you shouldn't really get that much of a return. But if you want to invest your money over a long time, well, you should get a higher return. So this is technically what a yield curve should look like, not this. And let me explain it to you. Okay, so what's happening right now, the Federal Reserve's keeping short-term rates high. And here's what it is. Look right here, 4.25. That's where the rate is right now, 4.25 to 4.5. See it right through there? All right, so that's why unless this really goes down over to here, you're not going to see these go down anytime soon, and you're not going to see mortgage rates change as well, because you can't get a 4-year treasury, or I'm sorry, a treasury bond at a high rate at 4.5, and you're not going to get any investors to buy bonds at, think of 4.5%, 5% coupon. So rates aren't going to get to 5% anytime soon. We need the Federal Reserve to cut short-term rates. Okay, that'll bring down the yield curve. This also helps banks, consumers, and everybody else, because the yield curve should look like this, an upward trend, not a bubble, basically a roller coaster ride throughout. So that's what's basically happening, why basically rates are just stuck where they are right now until the Federal Reserve starts to drop rates down here. It normalizes the yield curve, and that'll bring out some risk premium in the bond market as well. So this is not a normal yield curve, and if you want to go back in time to see what a normal yield curve looks like, well, that's what it looks like.